Welcome to the Retiring Canada podcast, where our mission is to educate and empower you to make the most informed, rational, and productive financial decisions. Hosted by certified financial planner, author, and chartered investment manager Michael Isbister, you'll go behind the scenes to uncover the tips and strategies to help you invest smarter, optimize your retirement income, and reduce the amount of tax you pay. Michael is an investment advisor with Fundamental Wealth, a trade name of Harbourfront Wealth Management, an IROC dealer. And now, here's your host, Michael Isbister.
Hello everyone, and welcome again to the Retiring Canada podcast. In today's episode, we're going to discuss how to best utilize the non-registered account as a retirement investor. Specifically, we're going to discuss understanding the difference between registered and non-registered accounts, the 3 ways your non-registered account is taxed, planning opportunities for retirees, the potential impact on government benefits, and lastly, as always, a few action items for you to consider. Now, the financial jargon in Canada doesn't really do consumers any favors. RRSPs, non-registered accounts, TFSA, LIRA, PRIF, LIF, defined contribution plan. Honestly, I can understand how hard it is for the average retirement investor to sort through it all. To make things a bit simpler for you and make sense of this in your brain, you can split all of these accounts up into 2 broad types: non-registered accounts and registered accounts. So, registered accounts mean that they are registered with the government and allow you to save or invest your money under certain terms and conditions. So, this includes the Registered Retirement Savings Plan, RRSP, Tax-Free Savings Account, TFSA, the Registered Education Savings Plan, RESP, and more. An investor can put money into these accounts that have tax benefits, and in some cases, grants, withdrawal restrictions, and more. Which leaves you with the latter, non-registered accounts. Some of you may call this an open or taxable account, but the term I'm going to use today is non-registered account. So in simple terms, there are non-registered accounts and then everything else. Unlike registered accounts, there is much more flexibility with no contribution or withdrawal limits. You also have the option to hold this kind of account jointly with your spouse, unlike most all registered accounts other than the Registered Education Savings Plan. Now, one more important distinction is how non-registered accounts are taxed. Unlike a TFSA, for example, which has completely tax-free growth, or an RRSP, which compounds tax deferred but is taxed as income when withdrawn, the non-registered account is subject to 3 distinct kinds of tax: interest income, dividend income, and capital gains. And all of them aren't created equal. Let's go through each of them. First is interest income. If our hypothetical investor received $10,000 of interest income, they would be required to pay CRA $3,800 in tax, or 38%. In this case, our retirement investor is left with $6,200 in their jeans. Pretty straightforward. Next is dividend income. Assuming the $10,000 is in the form of a dividend gross up and dividend tax credit are applied, leaving you with an effective tax rate of 20.5% or $2,050 in tax and $7,950 in your pocket. Lastly is capital gains. When we apply the capital gains inclusion rate, the $10,000 means only 50% of the amount is taxable at the investor's marginal tax rate of 38%. To keep the terminology the same as my dividend example, the effective tax rate is 19%. This means that there would be $1,900 in tax leaving the investor with $8,100 after tax. So, in summary of this hypothetical example, $10,000 taxed at 38% leaves an investor with the following after-tax amounts. Interest income with an effective tax rate equal to the marginal tax rate of 38% leaves our investor with $6,200. Next is dividend income with an effective tax rate of 20.5% and leaves our retirement investor with $7,950. And lastly, capital gains with an effective tax rate of 19%, which again is half of the investor's marginal tax rate, leaving him or her with $8,100. In its simplest terms, in a non-registered account, dividends and capital gains are tax preferred when compared to interest income. All right, so that leads me to my next point. Who should care about this? Well, obviously, if you hate tax as much as me, you likely care about paying our government less of it. But before you get to the point of investing in a non-registered account, there are a few other boxes you should check. First off, have you contributed to your RRSP or spousal RRSP to optimize your tax situation now and in retirement? Number 2, have you and your spouse maxed out your tax-free savings accounts? Number 3, is there a small amount of lingering mortgage debt that should be paid off shortly before you retire before investing elsewhere? With those out of the way, the non-registered account will start to make more and more sense as a long-term investment account. Many of you likely find yourself in the situation already with no liabilities, maximized retirement accounts, with investments being held in either an individual or joint non-registered account with your spouse. If this is you, let's run through a few planning opportunities and one massive pitfall that you should be aware of. So the first planning opportunity is the use of a spousal loan. This is useful in a scenario where one spouse has been the sole or majority income earner over the years and has amassed a large sum of non-registered investments in their name only. The higher income spouse loans money to the lower income spouse at the prescribed rate set out by the government. Now, going forward, all investment income inside of the non-registered account is taxable to the lower income earning spouse rather than the higher income earning spouse. This strategy is complex and requires annual monitoring by your financial professional, so please seek advice to see if this strategy makes sense for you and your family. Another planning opportunity is to utilize return of capital investments. These are investments that distribute a portion of your initial investment back to you as income. This return of capital is not taxable. However, these return of capital investments reduce your initial investment cost base and only delay an inevitable taxable event in the form of a capital gain. With this strategy, you are really kicking the tax bill down the road to a later date, which can make sense for some retirement investors. Next is the use of corporate class investments. These are a form of mutual fund or ETF that is registered as a corporation. The investment income generated inside of these specific fund styles is fully taxable as capital gains, which is tax preferred. A key difference between traditional mutual funds and corporate class funds is that the latter are only allowed to distribute dividends from Canadian stocks and capital gains dividends, both of which are taxed more favorably than regular income. Corporate class funds cannot distribute interest or foreign income. Such income is retained within the corporation, where it is subject to taxation unless it can be offset by expenses, and the class structure itself can pay income tax, which can reduce any tax benefits. Another strategy would be to utilize a segregated fund. Now, although these kinds of funds hold traditional investments, they are more of an insurance contract. Segregated funds can have guaranteed maturity and death benefit amounts. When held inside of a non-registered account, they also have the benefit of going straight to a beneficiary and not being subject to probate. However, these can often carry lofty fees into the 3% range, and in my opinion are best suited for investors trying to optimize their estate or protect assets from creditors, not as a core holding for retirement income purposes. Lastly is asset location. Now that you have an understanding of the three kinds of income, interest, dividends, and capital gains, you are also equipped to take a broader look at your overall retirement portfolio and search for weaknesses. So here's what I mean. Let's assume you have two accounts, a non-registered account and a RIF account, each with a $500,000 investment inside of them. The non-registered account holds GICs, and the RIF account holds a traditional dividend equity portfolio. As income is drawn from the RIF, it is fully taxable as income. And as the GIC pays interest, it is also fully taxable as income. If we assume a 5% interest and withdrawal rate, this will equate to $50,000 of taxable income. If we assume a 38% marginal tax rate, like we have used previously, this leaves our retirement investor with $31,000 in their bank account. Now, let's just say you switched the asset location. You put the GICs in the RIF and the traditional dividend equity portfolio in the non-registered account. The RIF is still fully taxable and distributes 5%, while the equity portfolio distributes 5% as a dividend. Now, after we factor in the RIF income and the dividend gross up and tax credit, our retirement investor now has approximately $35,000 in their pocket. No change in their risk tolerance, just a simple switch of the asset location saved our retirement investor $4,000. Sounds pretty straightforward, right? Well, there is one significant pitfall that can actually increase your taxes by 15% if not planned for properly, and this is called the OAS Recovery Tax. Remember earlier when I mentioned a dividend gross up and dividend tax credit when dealing with dividends in a non-registered account? Well, although they are tax efficient to your bottom line taxable income, the dividend tax credit is not applied when calculating social benefit repayments. So, in English, if you earned $10,000 in dividends, these would be grossed up by 138%, meaning your net income before adjustments, i.e., tax credits, would be $13,800, not $10,000, when determining if there is to be an OAS repayment. For all you tax nerds out there, this is line 23400 on the tax return. So, although dividends are tax preferred, you need to be aware how they will impact your social benefits. If you are keen on learning more about ways to avoid the OAS clawback, I encourage you to listen to episode 15 of the podcast. Okay, so there you have it, your crash course in understanding non-registered accounts and how they can play a part in your overall retirement plan. So let's get into a few action items for today's episode. First off, if you have an individual or joint non-registered account along with registered accounts like an RRSP, have a look at the underlying investments. Is there an opportunity to change the asset location to mitigate current and future tax liability? Number 2, if you are aggressively accumulating for retirement and there is a significant difference between you and your spouse's incomes, talk to a professional about the spousal loan strategy and discuss opportunities to shift future tax investment income to a spouse without triggering attribution concerns with CRA. Lastly, review your retirement income plan as it relates to your long-term planning goals. If you have charitable intent, the desire to gift your kids early, or simply want to minimize tax now and over time, developing a tax-efficient plan in your non-registered accounts that factors in all aspects of your finances will help to ensure you get the most out of your money while keeping the government out of your pocket as much as possible. Okay, so that does it for today's episode. For all the links and resources discussed, please check out the show notes or visit retiringcanada.ca. If you enjoyed the show, please subscribe and leave us a 5-star review in your favorite podcast app. Be sure to sign up for my weekly Retiring Canada newsletter, and hey, when it comes to your retirement, don't take chances. Make a plan so you can retire with confidence.
All comments are of a general nature and should not be relied upon as individual advice. The views and opinions expressed in this commentary may not necessarily reflect those of Harbourfront Wealth Management. While every attempt is made to ensure accuracy, facts and figures are not guaranteed. The content is not intended to be a substitute for professional investing or tax advice. Please seek advice from your accountant regarding anything raised in the content of the podcast regarding your individual tax situation. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.